Hey everyone, if you're a small business owner looking to grow, you're eventually going to outgrow your pocketbook and you're going to need a small business loan. Let me share with you a quick tip to evaluate the likelihood of you getting that loan. And we need to know two things. We're going to use Sally's Skate Shop as an example. And we need to know first our EBITDA. And then second, we need to know the total debt that we have on the company. But we'll come back to that for now. Let's look at EBITDA. At EBITDA, we need to know our net income that we reported on last year's taxes. Let's say $42,000, doing all right. And then we need to look at what we wrote off in terms of depreciation and interest. Let's say $12,000. So we add these two together and we're looking at basically $54,000 of earnings. Now let's look at the debt. That's in two ways. One, the existing debt that we have on the company. Let's say we got credit cards, maybe a term loan. We're making roughly $1,200 a month in debt payments. Plus, we got to add in the new debt. We're asking the bank for $150,000 over 7 years at 9% interest, which is basically $24.13 a month. We multiply that by 12 to look at the total debt annually, and we're looking at $43,356 in total debt for the year. If we divide our earnings by our total debt, we get 1.25. Shazam! This is the number you need to be at in most cases for most lenders. What we're saying here is we have $1.25 in earnings for every dollar of debt that we have in the company, including what we're proposing. Now, if you want to talk about these numbers and more as it relates to your business, I hope you can join us at our upcoming workshop on April 19th, where we're going to bring in a panel of lenders to talk about other things related to qualifying for a loan. But until then, thanks for watching.